You're listening to BFM 89.9, the business station.
Good morning, George. A week after the Fed announced a review of regulations allowing banks to trade in physical commodities, JP Morgan Chase revealed it has considered selling its business in commodities business. So if JP Morgan Chase should sell and the other banks follow suit, what impact is this going to have on financial stocks?
Good morning, Shao. Well, JP Morgan exiting its physical commodities business will probably temporarily reduce market liquidity for crude oil, natural gas, and power. If it decides to sell or spin off the physical commodities business and it becomes a new entity, completely new, the impact on the market would be very minimal and will be quickly retaken. If JP Morgan decides to shut the business or sell it to someone with the same business, it probably would drain some liquidity from the market. It's not going to be as important, but we're going to watch if Goldman Sachs and Morgan Stanley decides to get out of the commodities. Then the market will definitely take much more notice. We still overall think that a full-scale ban, which is on the table as part of the Fed's review, is not as likely as higher and differentiated capital charges on different commodities. In reality, there are two very good reasons for requiring banks to step back. One, it would simplify the financial institutions that are too complex, and two, it would limit the scope of the implicit subsidy that banks collect from taxpayers. But we do not expect to have the banks retreat completely. And if they do, investment banks in particular, Goldman Sachs, will find other ways to make up for the loss of revenues and also profits. Now, in overall terms, there are certain eccentricities in the way some of the exchanges, like the London Metal Exchange, run the markets. It's an oddity that their standard contract lets warehouses charge fees long after the owner of the commodity has asked for delivery. So it gives the warehouse owner a reason to delay in the delivery. That could be very easily taken care of by limiting the storage charges to 2 to 3 weeks after delivery has been requested. So there's some very good changes in the overall commodity works that would really help, regardless of whether the banks stay in or out of the business. There are some good reasons for the banks to be asked to leave, but I suspect that there will be some kind of staged reduction in their participation in the physical commodity.
Well, the chief equity strategist at JP Morgan has hiked his year-end target of the S&P 500 by 5% to 1,775 points, citing better commentary on Europe and its generally improving economic data. With his predictions being the highest amongst top Wall Street firms, is he being over-optimistic? And what's your personal view on this?
Well, Shao, I think it can be achieved. I think that based on where we are now, in absolute terms, it is rather optimistic. But I do think it's possible with some further economic improvement in the fourth quarter, particularly in October, September, that time period. Better Europe is definitely a possibility. Improving economic momentum broadly, that's also a possibility, but it has to be proved. His comment about the pent-up demand in the U.S. and to an extent in Europe, it's true, but I'm not as sure that it's as pent up and that it's going to be released quickly. We're still undergoing economic weakness, particularly in terms of employment. So I'm not sure that's going to be part of the economic factor until later in the year. Also, equities need to re-rate higher versus corporate bonds. I agree with him on that point, and I think it's quite possible. But again, the proof is in actuality, not at this point. Now, on the concerns that he indicated, the further deceleration of Chinese economic growth, we agree totally. And this is one of the areas that we're going to be watching very carefully, particularly as we get into October. As far as our tapering concerns with the Federal Reserve bond purchases, I think we've already started the transition, and I think the market will acclimate itself to the transition of market valuations to more fundamental economic fundamentals in a much easier way now that we've gone through that first impact.
Well, some sense a limit to the rally on the S&P 500 when looking at valuations. Currently, they aren't too far off historic highs of 16 to 17 times earnings. Are higher earnings multiples beyond that sort of 16, 17 times level justifiable, and how likely is it to happen?
They are justifiable if one can agree and believe in the fact that the economy is going to improve in a much stronger fashion than it is now. If that occurs, then I think the market itself will begin to see over the other side of the valley and start to improve or increase the multiples that it's giving to the S&P 500, for example. But at this point, it is pretty fully valued based on the economic progress that we're making now. It doesn't mean that it can't be valued higher, and we do suspect that multiples will start to improve or increase even higher than they are now, and that will be justifiable closer to October, November this year, when we are beyond just valuing the market based on low interest rates, and we're beginning to see a much stronger economic progress, stronger than what we're seeing now. But again, the proof is in the pudding. We really have to see progress first before we can establish higher multiples.
Federal Reserve meets later this week. Should we expect a reiteration of last month's message?
I suspect that there will be a focus on fiscal risk to the economy, concerns about low inflation. I think the Fed will verbally try to cajole the market to lower short-term interest rates as it has. So I don't expect to see much of a significant change in what we've seen most recently. I think the first shot was fired. The market got used to it. At this point, I don't see a substantial improvement in the market to justify an acceleration of expectations.
Well, this earnings season has been the narrowest range of results when compared to expectations. The biggest misses have come from the utilities, materials and tech sectors, and the biggest beats from financial and healthcare sectors. What sectors are you keeping an eye on right now?
Well, the banks continue to do well, the regional banks in particular. We like insurance, both life and property. Retail has always been one of our favorites, and now we're looking particularly at food and clothing. Energy is one of the up-and-coming sectors and industries that we're going to be watching, particularly oil and gas production. We've seen substantial strength in the last 2 weeks, and we suspect that will continue. Publishing is the sector that will probably have some strength, and in particular companies we're looking in the energy area for China Petroleum, Anadarko, and Occidental.
And what do you make of the recent spate of biotech IPOs?
Well, the IPO offerings in general have been the strongest that they have in 4 years, and biotech has indicated an ability to generate revenues and profits, and is one of the strongest areas for IPO possibilities. And this last week, boy, I tell you, it was quite a week for a whole group of biotechs. Biogen IDEX, Celgene, Alexion Pharmaceuticals all reported substantial Q2 earnings that beat estimates on Thursday, and then Thursday night, Gilead Sciences reported sales rose 15%, or over $100 million above the consensus. Biogen was also partially of particular interest to the market, since it was the first quarter after the launch of Tecfidera, which is its multiple sclerosis pill, and it could be a blockbuster. And in fact, revenues were reported 100 to 192 million versus the estimate of 70 million. So, don't forget Celgene. Celgene saw 15% revenue growth to 6.2 billion for the full year. So now we're beginning to see improvement in estimates of revenue growth going forward, and this is one of the most important factors that we need to see in order to develop a stronger conviction. And so I suspect that we're going to see biotech as a sector to be one of the more important growth potentials for the next quarter.
Thank you very much, Dodge. That was Dodge O'Dolan, Chairman and Chief Investor Officer of Lendo Infused Capital Managers in New York, on this morning's Market Watch.
BFM 89.9, the business.